All right. So I was going to do Campbell Soup, but Campbell Soup lost money. So I'm going to do Kellogg, and I don't know how to spell Kellogg. Is that close? Something like that? So I'll do Kellogg's, which means you can't do Kellogg's. So if you've already started, anybody doing Kellogg's already on paper 3 and 4? I haven't started 3 and 4.
A little bit to the left or to the right from your perspective. It's kind of like showing you.
Oh, is it? Am I in there? Yeah, you don't want to see me. All right, am I off the screen? All right, I'll have to edit that down. All right, so we'll do Kellogg's. Kellogg's is a fairly simple one. All right, I'll do it all in Excel, but you have to do it in Word, but I'll do it all in Excel. So what do you need to do to value a company? So we have, the first thing we need is a discount rate. So to get the discount rate on this, we know we're going to be using CAPM. You don't have to explain CAPM. Your boss will know that. Your boss will be really, really upset if you give them the theory of CAPM on a paper. I already know that. I did have an MBA working with me who had never heard of CAPM and beta. I was kind of shocked. I was like, where did you get your MBA? But most people will know what that is. CAPM says what? The discount rate on the stock equals the risk-free rate plus beta times the market risk premium. So paper 1 really is coming up with 3 numbers. All right? The risk-free rate, there's a few approaches. There's one, you just take the current rate, the current 10-year, and that's fine. You need to at least talk about the fact that the 10-year is back down below, or back down to 2.5%. Is that a problem for you that it's so low? There's a normalized approach. That's the approach I used to use, but I don't use anymore because rates have been so low for so long. There certainly is a normalized approach. I gave you a chart that helps with that. And the other one, which I like now, is the forward curve. You can use any one of these or 2 or some other approach, or you can do some research. I gave you an article by Damodaran that's a few years old, but it's still current because rates are still low, so you can read through his article, get his approach. I have another video out there that talks about the normalized approach. So let's quickly look through each one of these, and you can somewhat decide what you like. So the current approach, you just go out to Yahoo Finance, and you just find the current 10-year Treasury. I'm just going to round it. It's back below 2.5% again. I'm just going to round it to 2.5%. That still seems awfully low to me. Some students like to do a long-term history on it. It's really easy to get the 10-year Treasury back historically and just show that we're at a very, very low point right now, if you want to do that. So there's one. The normalized approach, I gave you a chart for that. Look under miscellaneous class materials. Charts to support stock assumptions, which is what we're doing, right? You can use several of these charts. So I gave you one that shows you, see if I can snip this one in, now that I know how to snip. Where'd it go? There it is. So normalized approach says, hey, there should be some relationship between the 10-year Treasury and economic growth. All right, the relationship is not real stable. We talked about in class that historically, the economy has been much higher than the 10-year Treasury. Or, yeah, the economy has grown, you know, a good 1.5% difference. I even show you the difference. Almost 3% difference. But since 1986, they've been almost the exact same number. You might say, hey, since 86, the 10-year Treasury has essentially equal economic growth. For your growth assumption in paper 4, you're going to have to use economic growth. For your market risk premium, you're going to use economic growth. So you need economic growth. So you can certainly say, hey, if I'm going to normalize the Treasury, 10-year Treasury, it should be somewhere comparable to U.S. economic growth. So we'll come back to that one because we need to get economic growth, which we'll do when we do the market risk premium, and you also do the other one. Forward curve, there's a YouTube. You don't have to do it, but I'd strongly recommend you know how to bootstrap the yield curve before you graduate, because it's really powerful. But I'll do it real quickly. What I'm going to do is I'm going to do the 10-year Treasury, the 20-year Treasury, and then I'm going to do the forward 10-year Treasury in 10 years. So what this approach says, which is why I'm moving toward it, is to say we're still in a very unusual period of time. The 10-year Treasury is not really the risk-free rate. The 10-year Treasury is just, there's something unusual going on with Fed policy, with how investors are tracking. I would not buy a 10-year Treasury to lock in 2.5% for 10 years. It doesn't sound like a risk-free rate. For me, it's barely going to give me inflation. So what I want to say is, let's take this current noise out, all the Fed's doing, and let's go out in 10 years and see what the 10-year Treasury will be. Now, we don't know what that is. That's a forecast, but we do know what the bond market thinks. Because, and I'm tempted to do the whole thing here for you, what is the 10-year Treasury? The 10-year Treasury is nothing more than the current 10-year and the 10-year in 10 years, right? That's what the expected 10-year in 10 years, right? That's what the 20-year Treasury is going to give you. It's going to give you today's 10-year Treasury plus what we think the 10-year Treasury will be in 10 years, which means embedded in the 20-year Treasury is their forecast for the 10-year Treasury in 10 years. That's well beyond all the noise of today. It gives us a very long-term perspective. So if you just type Treasury yield curve and search on it, it brings up the yield curve. And I'll use yesterday's numbers, which is fine. So the 20-year was 274. The 10-year is right at 2.5, but we'll use the actual number, 252. If you're going to make 252 for 10 years, but over 20 years you're going to make 274, where do you think the 10-year Treasury has to be in 10 years? Does it have to be higher than 274 or less than 274? If 252 for 10 years plus another rate for 10 years is going to give you 274, what does that 10-year future period have to be? It must be above 274, right? You must be making 252 plus 3% or whatever. So how do we figure that out? So it's a really simple formula. You just do 1 plus the 20-year, raise it to 20th, divided by 1 plus the 10-year, raise it to 10. You take that whole thing, raise it to 1 divided by 10, minus 1. And I did something wrong, so I don't know what I did. I always get I'm always missing a parentheses somewhere. That's it up there. That looks good, doesn't it? So what does that mean? You have $1,000 and you invest it at 1.0252 for 10 years, and then you reinvest it at 1 plus 296 for another 10 years. You should have 1708, or you can just take $1,000 and invest it at 274 for 20 years. You should get the exact same answer. All right, because that's what the 20 year is giving you. It's giving you 10 years at 252 and 10 years at 296. R is giving you 20 years at 274. The same thing. What if you think the future 10-year Treasury is going to be 2%? What would you do? Well, if you watch on video, it'll tell you. But if you think the future 10-year Treasury 10 years from now is only going to be 2%, boy, I would buy that 20-year bond. Because what is the 20-year bond giving you? It's giving you 252 at 296. If you think the future 10-year Treasury is going to be 4%, what would you do? I would buy the 10-year Treasury, and in 10 years I'd buy that 4% Treasury. So it gives you can actually, I don't know if y'all realize that, you can actually buy Treasury yields from 10 years from now. You can actually execute that today. Isn't that pretty cool? So what does that mean? My forward curve is 296. So you can use, if y'all want to use this, I'm not saying it's required for your class, it's required for life, so if you need it for life, you should know this as a finance major. If you're not a finance major, you can skip it. All right? So it gives us more normal, which to me is pretty interesting. Even 10 years from now, the bond market is still saying the 10 Treasury is going to be below 3%. They're not expecting tremendous economic growth, because remember, in a normalized approach, it says that should somewhat equal economic growth. Now you're thinking, well, 3% is not bad economic growth. We're not talking real economic growth, we're talking nominal economic growth. 3% would be a horrendous nominal economic growth number. So you'll see there's a lot of inconsistencies here. It's really, to me, really perplexing. These aren't numbers you can just pick up anywhere. So anyway, there's some numbers. I'm going to use the 296. Dr. Demodarian, we use the 2.5%. I used to use the normalized approach. I don't like normalized now because it gives you too high of a number to get what's going on. All right, now we need the market risk premium. And we're going to use the implied approach. You might explain the implied approach in there. It's a fairly simple idea. The concept is the required return on stocks should equal the expected return on stocks. The market risk premium is a required return on stocks, but that's a theoretical number that we can't get anywhere. We can't look it up. We can ask people for their advice or their expectations or whatever, but ultimately it's a theoretical number. But we can estimate the expected return on stocks. We did that on exam 1. So the expected return on stocks equals the dividend yield plus expected earnings growth of the S&P 500 stock index, right? Because we're doing the market risk premium of the entire market. On the risk-free rate and the market risk premium, if you talk about your company, you're doing something wrong. It is not the expected growth of Kellogg's earnings, it's the expected growth of the entire stock market. All right? We use the S&P 500 just as our benchmark. What else could you add this? Well, if you wanted to and get even fancier, you could add a buyback yield. That shows you an article on that, so yeah, maybe that's an extra 1% that you add in. If you're interested in doing that, then get that article and summarize some of that in there. It's not required. So the current dividend yield, we're going to use SPY because the S&P 500 index is a price-only index. We need dividends. The SPY is an exchange-traded fund on the S&P 500, and it does pay a dividend. So its dividends should be very, very similar to that of the S&P 500. So you go back to Yahoo Finance, and you click in the SPY, SPY, and you find its dividend yield. Boy, it's only 185. It's amazing how low it's gotten now. I'm going to put in the buyback yield based on Ibbotson. So if you want to do that, that's fine. I'm just going to put in an extra 1%. The argument is that firms are used to buy back stocks equal to what they were issuing or using for their stock buybacks, or for their option plans for their executives. But the last 10 years, firms have been buying a whole lot more of their stock back. Tremendously in my house. I think I'll show you all McDonald's. McDonald's net worth is negative. From an accounting standpoint, McDonald's, that massive corporation, has negative net worth ever since they bankrupted in the accounting version. Why? Because they've been buying about $40, $50 billion of their own stock. They did it to themselves. So yeah, companies are dispersing cash, their free cash flow, they're dispersing it not through dividends, but through dividends and buybacks. All right, and then the expected growth in earnings should be a function of economic growth, which should be productivity growth plus labor growth plus inflation. So here I gave you a chart that you can do that. this from exam 1. But you might want to put this chart into your paper. It just shows you productivity has trended in the 1 to maybe 3%. 3 would be a really aggressive number, but 1 to 2.5%. So 2's a pretty aggressive number. 2.5% is very aggressive. 3 would be really, really aggressive. But what do you think productivity is going to be going forward? I'll say 2%. If you argue higher than that, you're talking about electronic vehicles, driverless cars, new energy, new batteries, robotics, all kinds of things that could definitely make us much, much more productive. Labor growth. You can see labor growth has been pretty hefty in the past. It was negative that decade. The long-term number for labor growth has been about 1.5%. The last 2 decades, it's been much lower than 1%. I may go with 1%, but we do know the baby boomers are retiring. We're going to be heavily dependent on immigration to fill that gap. And that's not just in the U.S., all developed countries and China and Japan are having serious problems with shrinking labor forces. U.S. is actually in better shape than most. But I can't make an argument where labor growth is going to suddenly take off, especially like these people are retiring. Or you're hoping they're retiring, right, because you're going to take their jobs. And then inflation, there's a couple places you can do here. You could just say 2% because you have the Fed target. You might find a quote that says that. It'd be pretty easy to Google what's the Fed's target on inflation and find some quote. Or you could bootstrap the yield curve. I won't show you how to do that, but that's probably the way I would do it. But if you watch my YouTube video, it shows you how to do that because you can actually see what does the market think long-term inflation is going to be by just looking at the bond market. It's pretty cool that we can actually do that now. I'll stick with the 2. So that gives me economic growth about 5%. Y'all can see why I don't want to use this approach for my treasuries. So what did I say? Historically, treasuries has matched economic growth. I would feel very stupid using a 5% risk-free rate right now, given that we haven't seen anything near that for a decade. So yeah, I'll stick with my doing it 2.96%. So I don't like to normalize. That's why I stopped doing it. So I'm going to just say it's just too high. Maybe if you use this approach, right, you subtract 3%, maybe we're going back to this period where economic growth being much higher than treasuries, so maybe you can get it down to 2 or 3, but we haven't been there in quite a while. It's fairly interesting that, maybe you can justify subtracting out 1% or something, but then I can't see a risk-free rate much higher than 3.5%. I think 3.5 is about the max you can get to. We just have been in this low rate environment for so long. So this is my favorite approach, but you can use whatever approach you want. So what does that give me for a market risk premium? So the expected return in stocks is going to be a dividend yield. I'm going to add back a buyback yield plus my economic growth. I'm expecting stocks to make 7.85%. I think anything in the 6 to 9% range is reasonable. 6 may be a little bit low. You'll probably get 6 if you don't add back in the buyback yield. That's one of the reasons I like adding back the buyback yield, because I think you get a more reasonable number for expected return on stocks. I think you get above 9%, I think you're getting a little bit on the crazy side of optimism. Stocks historically have made 10 to 11%, but that was with a 4% dividend. We don't have a 4% dividend now, we only have a 2%, so I don't think economic growth is going to be that high because inflation is much lower. So a lot of that 10, 11% was just inflation. Inflation's been 3-something%. So I think you got to come off at least 2% off of the historical numbers. But you got to justify it. If you use 14.7%, I think that's crazy. But if you have it well justified and logically, that's fine. We used to assume 13% returns in stocks back when I was doing this 30 years ago. It's amazing what we used to believe. So what's my market risk premium? My market risk premium is not 7.85. Our market risk premium is the expected return on stocks minus the risk-free rate. So my market risk premium is 785 minus, I'm going to use the 296. So my market risk premium is 4.89%. That's market risk premiums. Boy, if you get below 3, I think you're getting a little crazy. If you get above 6, I think you're getting a little crazy. But you can justify it. I'm not saying there's no one out there not using a 7% market risk premium. I think it would be really quite bizarre. If you use anything in the 4 to 6% range, you'll probably get decent valuations for your stock. If you get out of that 4 to 6% range, you're probably not going to like your stock valuations. It's going to be a little bit wild. So there's my market risk premium. All right, any questions up to there? We're on video, so write your questions down and we'll ask them at the end, all right? Unless you want to be on the video. All right. So what do we have left? We have beta. Well, we've already done beta, right? We've been practicing that. What 4-step process, what we do for beta. We got to decide what type of stock is Kellogg. Defensive or cyclical? Is that a difficult one? Anybody want to debate and argue Kellogg's is a cyclical company? Anybody cutting back on Kellogg's because you're worried about your job, worried about the economy? So I'll wait until the next election and then I'll load up Kellogg's depending on when that comes out. That's probably not a discussion you're having anywhere. So this is obviously a defensive company selling a consumer staple. Very, very obvious. Step 2, we talk about the operating leverage. So here you want to have some discussion about the firm itself. I'm going to assume that this is quasi-manufacturing, right? They have a plant that produces stuff. It's probably unionized labor, I would guess. I don't know that. Where does Kellogg actually produce its stuff? It's probably unionized, wouldn't you think? So that gives us some fixed costs. It has raw materials that it probably passes on price changes in its prices, I would think. You know, if wheat prices go up, I imagine they're going to increase the price of what do they do? Kellogg's Frosted Flakes. Sugar prices go up, they're probably going to increase the cost of that. Most people realize that if sugar prices are going up, grain prices are going up, they're going to have to spend a little bit more for cereal. So there's probably some protection there. I'm going to say it's probably a bit below average. I'm just guessing, but I have some discussion there. So the class notes tell you kind of things you can look at. They have hourly workers, they have unionized workers, they're on salary. How quickly can they change their workforce? Do they have a lot of property, plant, and equipment? There's some things you can do to figure out, does this firm have a lot of fixed costs? Or is it all variable costs? I'm going to assume there's somewhat of a mix. They're probably, I think, somewhat of an average firm. But what else can we do? Well, if you go into Blackboard, and you look under miscellaneous class of materials, I have that file, just for the word beta, Excel file to help determine beta. And helps you with both operating leverage and debt to equity. So you just click in the green cell, hit the equal sign, and go find your company alphabetically. You have to do it by the ticker, not by the company name. So Kellogg should be their very, very first company. So there's Kellogg's right there. It looks like fairly stable gross margins, doesn't it? except for here recently, you're definitely seeing some drawdown. Look at that. We know consumer staples are having trouble with gross margins. They're getting squeezed. If any of you are out doing that in your earnings report, gross margins is a huge issue for firms like Kellogg's and Campbell Soup because raw material prices are rising, but because of competition, they can't rise their prices, so they're getting squeezed, and you definitely see that there. So we look at the gross margin. It's slightly lower volatility than the S&P. So the S&P's gross margin has a standard deviation of about 3.81%. Kellogg's is 3.58, so slightly below margin, below average. Their net margin, they're actually somewhat more stable than the market. So that argues for a lower beta. So you can certainly bring that in. So standard deviation of margins suggests slightly below average operating leverage. So you can bring this into your paper, maybe clean it up some so you don't have all the lines like that when it works. Step 3 is the easiest. You just ask for financial leverage. And one thing we're noticing with the consumer staples is, boy, they're putting on a lot of debt. This is like incredible desperation. We got to do something. Let's buy everybody in sight. So here's their debt to equity. Their debt to equity is almost 400%. The typical company, S&P 500, is at 72%. So does this firm have a lot of financial leverage, average, below average? What adjective will you use? Slightly above average? Well above average? Significantly above average? So you got to figure out what word you're going to use. I would say significantly above average. That would be high even for a utility, so yeah, that's definitely above average. Here you don't need much discussion, you just got to say debt to equity is well above a typical S&P 500 company. The equity is spelled with a high, not with an 8. All right. Anybody remember step 4? That's the last one. Look at their history, right? So how do we do that? I'll do this on a separate page. See, a video shows you to do this, but we'll do it real quickly. It's pretty simple to do. So I'll just put Kellogg's in there. Get their historical data. Take the max back to 1980. That's pretty cool. I'm going to do monthly. Hit the apply button. Bring in Kellogg's. I'm going to get rid of the very first month because we don't know when you really started. Get rid of the April because we're not through April yet. The only data we need is the adjusted close, so I can get rid of everything else. Not everything else. I need to keep adjusted close. So there I have it. So there's Kellogg's. So I'll do the S&P 500 next. So click on the S&P 500, historical data. I'm not going to do the max here. I'll do 12/31/1979 monthly. All right, where did I start Kellogg's? Let's see. $4,180. So I'll do the same thing with the S&P, $4,180. Bring that over. I'm going to bring the dates over just to make sure I have it lined up. $4,180, free. That looks good. S&P 500, I got Kellogg's. So I'm gonna bring this over to